Hello, everyone. My name is Michaela with Taxes and Retirement 567. I want to go over a little housekeeping to help optimize your webinar experience today. To the right of your screen, you will see a Q&A section. This is completely private and only visible to the presenter. If you have any questions for Bruce throughout the webinar, please feel free to leave them here. If he does not get the chance to get to them during the webinar, he will be sure to follow up with you after to get those questions answered. To the right of the Q&A section, you will also see a handout section. Bruce has left a handout there for you to either view or download for your keeping. Throughout the webinar, you will see a few poll questions pop up on your screen. We encourage you to answer these, but if you do not wish to, you can simply click do it later. You will also have the chance to schedule a complimentary consultation. You will see a pop-up offer on the bottom left of your screen. Please feel free to click on this at any time, as it will direct you to a new tab so that the presentation is not interrupted. And without further delay, I'm going to hand it over to your wonderful presenter, Bruce Duell.
Hi, everyone. What is this? A $5 bill? You might think it is, but that's wrong. This is your entire retirement nest egg. This is everything you've saved and invested, everything you've done without for the last few decades. This is your Social Security, your pension, your 401k, your IRA. This is your home. This is everything you have. This is the whole ball of wax. It's taken your whole life to put this together, and now this needs to last you up to 35 years in retirement. But there's a problem. There's a problem. The problem is the IRS wants its piece. The IRS wants its piece. Inflation, which is climbing, wants its piece. Medical care, which is the single most expensive thing in retirement and is going up at 3 times the rate of inflation, wants its piece. The kids move home and they want their piece now. If you decide to sell your home, the IRS wants a piece of that. The IRS even wants a piece of your Social Security. This is what is left for you. Folks, we are facing a crisis, and you are here tonight to learn how you can put this all back together. You're here today to learn some very valuable things. My name is Bruce Duell, and I'm going to take you on a journey for the next 60 minutes that I think will result in some great success and added confidence for everyone on this webinar. I typically run in-person webinars, and one thing that's great about these seminars is that I stick around after the seminar and I speak with attendees. We won't have the opportunity to do that today since this is a webinar. I assure you I want to address all your questions and concerns, so what I'd like you to do is take notes on any questions that you have throughout this webinar. You can even drop them in the question and answer box, because I'm the only person who can see the comments there. Besides Michaela. I'll try to get to the questions, but I likely won't have time to cover them all. What I am going to do is call each one of you within a couple hours of this webinar to go over any outstanding questions or concerns in a time for a strategy session in Calendly, so should you so desire. If you want to lock in your perfect time and date that works best for your schedule in Calendly, you can do so at any time during the presentation. Before we dive into our presentation, let's warm up with a little brain teaser about Bill. Sounds like fun, right? So, after working hard for his entire adult life, Bill, 65, has finally retired. He's going to more concerts than ever before. Bill has $42,475 in taxable income, which includes $25,000 Social Security benefits this year. As you can see, Bill's $42,000 of taxable income puts him in the 22% tax bracket because it's more than $40,125 and less than $85,525. Toward the end of the year, Bill decides to take an extra $1,000 out of his IRA for a trip to see Willie Nelson play in Austin. How much is he taxed on that extra $1,000? Let's take a look. The logical answer is that for every dollar of IRA money he pulls out, he pays 22 cents in federal income taxes. Therefore, if you took out $1,000, you should owe $220 in federal income tax, 22% tax. Simple enough, right? He owes $407 in tax, a 40.7% federal tax rate on that income. Thanks to the madness that is our tax code and the unique formula that determines how your Social Security benefits are taxed, the real answer is that Bill owes a $407 on that extra income. Shocking, right? Almost to the point where it can't possibly be true. I mean, if the top rate for a single tax person is 37%, and that rate doesn't begin till he has more than $510,000 in taxable income, how can he pay a higher rate with much less income? It doesn't make any sense. But here's the thing, it doesn't have to. It's the tax code after all. Later, I'll explain more about why Bill faces that tax bill, but for now, the important thing to realize is that when it comes to taxes, the obvious answer is not always the correct answer. So, welcome to our presentation. How tax planning changes through 4 stages of retirement. My name is Bruce Duell, and I'm an advisor with Permanent Value Incorporated. I thank you for coming out to learn more about taxes and retirement. And I want to assure you of one thing about this presentation. I believe you'll be better informed about the challenges of retirement tax planning after listening to this talk. Now, you may be wondering, what is a financial advisor giving a presentation about retirement tax planning for? From time to time, I present workshops and classes on various financial education topics such as retirement planning, IRA planning, healthcare planning, and late-stage college planning, among others. My goal is always to inform and educate my audience so you can understand how critical financial strategy topics affect you and your family. I do this presentation because I've seen so many people make mistakes and pay more taxes in retirement than necessary. When that happens, it makes my job harder because people have less income in retirement and we have to find ways to make their portfolios last. Taxes can seem complex and jargon-filled, even though the underlying concepts are fairly straightforward. So let me take a second to explain how this workshop will unfold. The presentation is organized into 4 keys. Each key builds on the previous one to form a solution to our presentation problem, as you'll see. Now, you may have questions as we go along, so please type them into the question and answer box. I'm always trying to respect people's time, so I won't be taking questions during the presentation so that I can be sure we'll be done on time. But I will take questions at the very end, and I'll be glad to talk with you about your specific situation. So go ahead and write them so you can remember them. There's a section for questions. I want to mention that at the end of our presentation, I'll invite you to a taxes and retirement planning overview meeting. This is a complimentary one-on-one meeting, so I can offer what we can discuss in private, the issues that are raised by tonight's presentation. I'll tell you more about that later. But now, there's another important point I need to make. Seek professional tax guidance. Everyone's tax situation is different. You should always consult a qualified professional tax advisor to discuss your specific tax situation, especially about these topics. Traditional IRAs, which are typically tax deferred. You must pay taxes on distributions or conversions at ordinary federal and state books. Roth IRAs, which are non-deductible, the money goes tax-free and earnings may be withdrawn tax-free in accordance with IRS rules. State taxes. This presentation references federal taxes. You may still face state taxes. Check with your tax professional. I'm an investment advisor and I do not provide tax advice. What I do is help people understand how the tax code and other rules could impact their financial strategy and investments. And then we develop a plan to take into account many of the odd things people encounter, especially around taxes in retirement. Our goal here is to help you understand that the retirement distribution game, spending assets in retirement, is much different than the accumulation game when you're saving for retirement. Chances are you've been in the accumulation phase of your life for several decades, and you've been working hard and trying to save money, and hopefully your accounts have grown. But now as you enter or prepare for retirement, you're in an entirely different phase, the distribution phase. And the distribution phase has new, strange rules that can catch people off guard. And along with those new rules, there are often many changes in your own personal life that can have a big impact on your taxes too. For instance, your children are grown, and that means no more child tax credits. Your house may be fully paid off. That means no more mortgage interest deduction. If you've already retired, you may no longer be receiving tax-free employer-paid medical insurance. If you stop working, you may no longer have the ability to stash income in a 401k or similar plan to manage your annual tax bill. At some point, you'll start taking Social Security, and sooner or later, when you reach 72, you'll have to start taking required minimum distributions from your retirement accounts. The list of changes goes on and on. Many aspects of retirement will affect your tax bill in ways totally different from your working years. Understanding what these are and how they can impact you is absolutely crucial. Okay, we have our first poll question come up. And if you'd like to answer that, the poll question is, what's currently your greatest concern regarding your retirement assets and plans? So your choices are recent stimulus and how it might impact my retirement, losing money in the stock market, running out of money in retirement, being unprepared for unexpected healthcare issues. So go ahead and submit your response to the poll question, and we'll take a look and see how you all answered this question. I will keep moving through our presentation. I'll give you an update on what our results are. Okay. So, the problem. This brings us to a simple statement about the problem we're here today to discuss. Simply put, people often pay more taxes in retirement than expected because the confusing system treats various income types differently and contains hidden taxes and penalties. In the accumulation phase, people build their assets in several different forms: stocks, bonds, real estate, pensions, 401ks, IRAs, and more. In the distribution phase, your regular wages stop coming in. You have to take money you've saved and use it to fund your retirement, which can go on for decades with good help on your side. That's challenging because you'll need to make informed decisions about the tax implications of tapping different accounts, and it can be costly. In retirement, your tax rate can vary dramatically based on decisions you make, such as the timing and order in which you use different sources of money to pay for your expenses. Poor choices through misunderstandings or ignorance of the rules can result in people paying more taxes than necessary. As a result, they may see their savings drop faster, and that can mean less to leave to the kids and the grandkids. Of course, we don't want that to be you, and the fact that you are here means to me that you are willing to work towards a solution, which is an important first step. Because your tax exposure will change throughout 4 stages of retirement, you'll need a strategy that anticipates both traditional taxes and possible taxes, surcharges, and penalties related to Social Security, Medicare, and other income sources. This means you'll need an informed and proactive plan that addresses how you create your income in retirement. My goal is to introduce you to the major aspects of such a strategy and show you the challenges we all face, and then explain what makes up a workable solution to our retirement tax problem. The first step is to develop an understanding of the types of taxes you may face. What do I mean by taxes? I'm talking about all the costs that can increase as your income does, including some that aren't actually called a tax. To me, if your cost goes up as your income tax rises, it's a tax in my book. You also need to understand the retirement expenses you'll face, and you'll need to create a strategy that will help you decide which of your assets to tap first, how much you should be taking from those assets, and when those distributions should occur. Getting this right will help you pay as low a tax rate as possible. Okay. Now, at this point, you may be thinking, what's the first thing I need to understand about retirement taxes? Well, here it is, our first key. You have to know what your after-tax retirement savings picture looks like before you can actually retire. Let's look at an example. Because a $500,000 401k or IRA balance isn't really $500,000. The government has a claim on part of that money because the taxes were deferred. They'll get that share when you're forced to start your required minimum distributions after you turn 72. Obviously, the higher your tax rate of retirement, the less your account is actually worth. Now, I want to note that required minimum distributions have been suspended for 2020 as part of the coronavirus aid relief and economic stimulus package. So if you're turning 72 this year, you won't have to worry about your first distribution. But we all hope things will be back to normal by 2021, and your required minimum distributions will begin next year. Here's an example. This chart shows you the cumulative after-tax amounts you could expect to receive from a $500,000 IRA, earning 6% a year at various tax rates. As you can see, the lower your tax rate, the more you keep. Simple in theory, difficult in practice. And by the way, of course, this presentation applies to both pre-retirees and retirees, so don't worry if you've already started your retirement. Tax planning is important throughout retirement. Okay. Now you may be thinking, okay, my accounts may not be worth as much as I thought, but I'll have a steady flow of benefits from Social Security to supplement my income, and I'll have Medicare to pay my health costs. But one thing you need to understand when creating a retirement tax strategy is Social Security and Medicare have their own tax traps that you need to plan for as well. Okay, let's go back to Bill from our earlier tax brain tease. We want to understand why he paid such a high tax rate on the extra money he took from an IRA to go on a concert road trip. Remember, Bill has $38,000 in IRA income, part of his adjusted gross income of $56,525, and he has $25,000 of Social Security benefits. That puts him squarely in the 22% bracket, and he takes the standard deduction. Yet, when he took that extra $1,000 IRA distribution, he got hit with a nearly 41% marginal tax rate, $407 on that $1,000. Let's break down how this actually happens. First, let's remember the only difference between our two scenarios here is that Bill has taken an additional $1,000 from his IRA. You see that in the after concert trip column, he has $39,000 in IRA income. So we see here that by adding that additional $1,000 of actual income, it increases both his adjusted gross income, AGI, and his taxable income by $1,850. That means that for every dollar of income he actually received, he's being taxed on $1.85. Huh? How does that work? Here's the deal. Depending on how much other income you have, the amount of your Social Security benefits that are taxable varies. For instance, if your other income is low enough, all of your Social Security benefits will be income tax free at the federal level. On the other hand, if your income is high enough, up to 85% of your Social Security benefits can be taxable at whatever your personal rate is. Bill finds himself in the latter scenario. At his current income after the concert trip, for every dollar that he takes out of his IRA, he not only adds $1 of IRA money to his taxable income, he must also add an additional 85 cents of taxable Social Security benefits. And if you add that up, that's a $1.85 taxable on his 22% rate for every $1 of additional IRA income he actually receives. If you do the math on that, it comes out to 40.7% real tax rate on the additional $1,000 in income. That's the so-called Social Security tax torpedo. It can impact single fathers and married couples with even fairly modest income during any stage of retirement. It's one reason planning taxes in retirement is so important. So let's look at another aspect of Social Security and taxation, how people approach retirement. Now, during the earning and saving years, some people retire altogether, but other people enter into a sort of semi-retirement. Sometimes it's a continuation of a previous job, just with fewer hours. Others use semi-retirement to explore an interest in a new field. Still others use semi-retirement to pursue non-paid, rewarding volunteer work. So working in retirement can impact your planning and taxes in a number of ways, some good, some bad, and some downright ugly. Okay, it looks like we have our next poll. The question is, these three issues are critical to financial independence. Which do you think is most important? The choices are a coach, a written strategy, regular financial education. So go ahead and click your response, and we'll see. Let's see what our poll suggested. Okay. So let's take a look at how working during these years can be a good thing. Chances are you've researched what your Social Security benefit might be at various stages, but you may not know that your Social Security benefit is calculated using your highest 35 years of inflation-adjusted earnings. Well, what if you started working late in life? Or what if you left work to raise children? You may not have 35 years of earning history. Suppose you only have 28. The remaining 7 years count as big, fat zeros when you calculate your benefits. But there's good news. Earnings at any age can help you increase your Social Security benefit. And thanks to how Social Security calculates benefits, placing several years of zeros with even modest earnings can positively impact your benefit. Now, let's look at how working during your highest earning years can be somewhat bad if you're already collecting benefits and unaware of the Social Security earnings limit that applies prior to you reaching full retirement age. Here's how the rule works. If you start Social Security, get your own retirement benefit or spousal benefits prior to the year when you reach your full retirement age, for every $2 above a certain amount that you earn, $18,240 in 2020, Social Security will withhold $1 of benefits. Keep in mind that we're talking about earnings here, like a W-2 salary or self-employment income, not pensions, interest, dividends, and capital gains. They don't count and won't reduce early Social Security benefits. For instance, let's say that you earn $20,240 in 2020. That's $2,000 over the limit. Therefore, under the $1 withheld for $2 earnings rule, Social Security would withhold $1,000 of your 2020 benefits. But these benefits are not truly lost. When you turn full retirement age, your benefit will be adjusted to make it as if you had applied a full retirement age with respect to those withheld benefits. In other words, your benefit going forward will be a bit higher. Also, in the year you reach full retirement age, there's a separate higher earnings limit. Okay, we've talked about the good and the bad. Now we're going to talk about the ugly. We're here today to talk about taxes in retirement, but there are other taxes you may face too. For instance, while you're working, you're subject to these 7.65 Social Security and Medicare taxes, in addition to income tax. The self-employed pay twice that amount, 15.3%, to cover the employer's contribution. Now, those taxes don't go away if you're working past your full retirement age, even if you're collecting Social Security. Worse, if during your best earning years you don't make it into your top 35 years, those Social Security taxes go into the trust fund and don't increase your benefit. Medicare and taxes. Now, let's take a look at how Medicare and something it calls IRMA can impact some couples in the best earning years and beyond. First, what does IRMA stand for? It stands for Income Related Monthly Adjustment Amount. The emphasis is on income because it is a monthly tiered surcharge. Again, a kind of tax that is tacked on to people's Medicare Parts B and D premiums. But it only happens if you have income over $87,000 for singles and $174,000 for married couples. So let's take a look at what this means in action. Meet George and Martha. They are a high-earning married couple, and both are Medicare Part B and D participants. IRMA surcharges affect income from 2 years prior, and this couple was on track for $271,500 of modified adjusted gross income, or MAGI, in 2018. But on December 1st, George decided to sell a stock he bought for $10,000 on July 1st, 2007. He sold the stock for $11,000, and the resulting $1,000 of gain was taxed at the 15% long-term capital gains rate, plus an additional 3.8% net investment income tax, surtax, for a total federal tax bill of 18.8%. That 3.8% net investment income surtax is another tax that comes into play when your MAGI exceeds $200,000 for singles and $250,000 for married couples. So George and Martha owe $188 of tax on the gain from their sale of the stock, right? 18.8% of $1,000, or do they? Look at this Part B IRMA chart. That extra $1,000 gain pushed their adjusted gross income into the next premium tier that starts with $272,001. So now, instead of owing $289.20 each for their monthly Medicare Part B premiums, George and Martha will each owe $376 per month, an extra $86.80 per month, times $273.60, for an annual total in income-related monthly adjusted Medicare Part B premiums of $2,083. But it's not over, because Medicare Part D IRMA charges are also impacted. George and Martha will each owe about another $19 per month for their drug plans, an extra $461 for the couple over the course of a year. Adding all the IRMA surcharges together for the year, George and Martha will each owe about an extra $100 a month, or about $2,500 for the year. Now, combine that with the $188 of actual federal income tax they would owe on their stock sale, and the total tax owed on the $1,000 of gain comes to $2,732. That's a tax rate of 273%. Let me repeat that again. That's a tax rate of 273%. So let's do a quick review. They sold stock for a $1,000 gain. The stock sale was $188 in tax, 15% for long-term capital gains, and 3.8% for the net investment income tax for high earners, for an 18.8% rate. The extra income from the stock sale triggers new IRMA tiers. The total IRMA surcharges amounts for the year to $2,544 for George and Martha. So the $1,000 extra income triggers taxes of $2,732, 273% real tax rate. You see, being pushed into a higher Medicare Part B and Part D premium range is worse than being pushed into a higher tax bracket. That's because if you go over a regular tax bracket by even a single dollar, only those dollars are taxed at the highest rate. But if you go over the Medicare Part B and D income levels by even a single dollar, you move into the next premium tier. It doesn't matter if you exceed the limit by $1 or $10,000. That's what they call the IRMA cliff. Keep in mind, your IRMA payments aren't determined by how much money you made the previous year, but rather your MAGI, modified adjusted gross income, from 2 years ago. It's another tax thing that catches people by surprise and needs careful planning. Making sure that you enroll in Medicare at the right time is a critical decision. If you bungle it, you'll get hit by a lifelong penalty. To help you understand, meet Jim and Ann, both 68. Jim retired at 65 and Ann retired at 66. Prior to her retirement, the couple had health insurance through Ann's employer, and they continued that even after Ann retired because her employer offers retiree health benefits. Unfortunately, they didn't know that they had to enroll in Medicare Part B as soon as Ann retired. Even though Ann's employer offers retiree health insurance benefits, those benefits are generally paid secondary to Medicare after retirement. But Jim and Ann didn't realize the mistake until it was too late. And thanks to the way Medicare enrollment periods work, they weren't able to begin coverage until the next year. In a worst case scenario, this might have resulted in a gap in coverage for Jim and Ann if they had a major medical need. But even in a best case scenario, because Jim and Ann missed their deadline to sign up for Medicare Part B, they will each owe a 10% Medicare Part B base premium penalty for life. You can see how much that translates to in real dollars. They owe $347 extra in 2020. Historically, we can estimate that premiums will be higher, so that 10% penalty will grow and grow and grow. Over the course of their lifetime, it could translate into a $10,000 mistake for the couple. For simplicity's sake, we're assuming that Ann's retirement health insurance covers prescription drugs, so they don't have to sign up for Part D. Just know there's a penalty for that too. All right, we got another poll question coming up, and it relates to Social Security and Medicare, which is what we're talking about. So the question is, given the current $26.7 trillion national debt, how confident are you that Social Security and Medicare will provide their current level of retirement income and healthcare benefits for your lifetime? Our choices are very confident, somewhat confident, not confident at all. So go ahead and answer that, and we'll see what the poll comes to. Okay. We've seen how Social Security and Medicare have their own tax traps and unique rules and penalties. So if you're like some who've seen this presentation, you may be asking yourself, wow, are there other tax traps we will face in retirement? Well, the rest of what we'll cover isn't like what we've seen with the Social Security tax torpedo, or the Medicare IRMA cliff. The public generally isn't aware of these tax squeezes. What we're going to see now is how the tax code in plain view snags retirees, especially when there's no planning. And that brings us to our third key. You must plan how and when you will use taxable, tax-deferred, and tax-free assets to manage your income and tax brackets efficiently. You can't be haphazard about tapping your tax-deferred savings. Timing is everything. And if you don't plan carefully through all stages of retirement, you'll encounter unintended tax consequences. Let's take a look by first addressing a question I hear often when doing retirement planning. Which accounts to spend first? Here's a common example, Sam and Mary. They've been good savers, as you can see, and are looking forward to spending their retirement years traveling and seeing their grandchildren. In addition to Social Security benefits, they have $450,000 each in an IRA, $60,000 each in a Roth IRA, and $300,000 in a joint bank account. They want to spend about $8,500 a month, or just over $100,000 a year. Where would you take the money from first? Here in an alternate approach, there are two key elements in the early years. First, Use the taxable bank money for expenses, but also during the same period, accelerate IRA distributions during otherwise low income years, putting that money into Roth accounts. This is the filling your tax bracket approach, which we'll discuss in a second. This alternative approach gives you more flexibility to use that tax-free Roth money strategically in future years. Does it make a big difference? I think so. In the academic studies, this approach has been shown to increase portfolio longevity. That is how long your non-Social Security assets last before being totally spent, by up to 2 years. The big takeaway here, of course, is that you've got to plan all the way through retirement, especially around how you handle your tax-deferred assets. And of course, see your tax professional for tax advice. One way to help manage, we've got another poll question here, so let's get into that first. Again, it's related to Social Security and Medicare. How confident are you that you will be able to provide for all your retirement and healthcare needs without Social Security and Medicare? Our choices are very confident, somewhat confident, not confident at all. Okay, so go ahead and answer that, and we'll look at the results later. All right. So again, one way to help manage your income both before and during retirement is to utilize Roth IRA conversions. A Roth IRA conversion is a simple process that allows you to move money from an IRA or other pre-tax retirement account like 401k to a Roth IRA. In general, the amount that you convert is added to your income for the year and will be taxed at your rate. For example, if Jill converts $100,000 from her IRA to a Roth IRA, she will have to add $100,000 to her income. The conversion income will be taxed at Jill's rate. For that reason, it's recommended that prior to making any conversion, you consult with your tax professional. A conversion doesn't need to be all or nothing though. One helpful conversion approach is called filling up the bracket. Often you might find yourself in the middle of one of the tax brackets with room to have more income without pushing yourself into a higher bracket. For example, in 2020, the 22% tax bracket for married couples, filing a joint return goes from about $80,000 to about $170,000. If you file a joint return and your taxable income is $100,000, that means that you could add another $70,000 of income without going into the next tax bracket. Making a Roth conversion like that could make sense. If you plan to convert a large IRA, this approach is often more tax efficient than converting the full amount in 1 year. Instead, you can make smaller Roth IRA contributions over a number of years, filling up your bracket each time. This can help reduce the average tax rate you'll pay on your converted money and also spreads the tax out over a longer period. Roth IRA conversions can be especially powerful in years when your taxable income is low, such as having a higher non-recurring medical expense deduction or a low sales year for business owners. It's also common for people who retire early and are not yet receiving Social Security benefits, pensions, or IRA distributions. They may have a very low tax bracket, making it a good time to complete Roth IRA conversions in those pre-RMD gap years. So this is a good time to spell out the crux of things. You must know whether you're trying to keep income below a bracket threshold to avoid bumping up to the next highest tax rate, or whether you're trying to increase income to fill up a bracket to take advantage of that tax rate. Some tactics that you could use in managing income around tax brackets might include withdrawing tax-free money from life insurance policies to keep income low, selling highly appreciated stock for low or no capital gains, taking distributions from IRAs or 401ks to take advantage of a lower tax rate. And as we've seen, you can also consider partial Roth conversions to fill up lower tax brackets. There are also two other pre-retirement strategies to consider, but they don't apply to all people. The first has to do with how you use a health savings account. This would only apply to people who are covered by a high deductible health plan. The initials are HD, HP. The second has to do with high earning small business owners who fund company pension plans and become eligible under the new tax law for something known as the Qualified Business Income or QBI deduction. Both of these features of the tax code could be used to manage your tax exposure and provide significant tax-fair benefits throughout retirement. If either or both these apply to you, go ahead and note that now on the question area of your evaluation form, we can discuss it later. We've seen throughout our presentation the critical importance of managing our tax-deferred accounts. Because once you're over 72, you are forced to take out required minimum distributions, or RMDs, except in 2020, of course. And that can be troublesome to your tax bill. But many people make charitable donations supporting their favorite nonprofit with annual gifts. So let's take a look at how your RMDs and charitable giving may work for you with some planning. Meet Albert and Shirley, who are in the 24% tax bracket. Now, the standard deduction for a married couple filing a joint return in 2020 is $24,800. But Albert and Shirley are over 65, so they each get an additional standard deduction, bringing their total standard deduction for 2020 to roughly $27,400. This means they will receive no tax benefit or any itemized deductions unless their total exceeds that $27,400 mark. So if Albert and Shirley have $15,000 of existing itemized deductions, say from state and local taxes, deductible medical expenses, and mortgage interest, what happens tax-wise if they donate $5,000 to charity? They get no federal income tax benefit for making the charitable contribution because it doesn't exceed their $27,400 standard deduction. Now, if you're over 72 and have an 72 now, and have an IRA or inherited IRA, there's another way to give to charity than simply writing a check. It's called a Qualified Charitable Distribution, or QCD for short. Let me explain how it works so you can see why QCD can be so powerful. For some rules, if you are over 72, you can make a qualified charitable contribution of up to $100,000 each year from your IRA. If you're married and both of you are 72 or older and both of you have an IRA, you can each make up to $100,000 qualified charitable contribution from your own IRA. Second, if any qualified charitable distributions you make count towards satisfying your required minimum distribution for the year. However, when you make the distribution from your IRA, it must go directly from your IRA to the qualified charity, or you can receive a check from your IRA custodian made payable to the charity. Third, and this is the odd part, even though you gave to charity, you get no income tax deduction. So why would I suggest a strategy where you get no deduction for giving to charity? Because when you make a qualified charitable distribution, the distribution from the IRA is never counted as income when you compute your taxes. Let's see how that helps Albert and Shirley. First, let's suppose Albert and Shirley do what many retirees would do. Albert takes his required minimum distribution of $5,000 at the beginning of the year and deposits it into the bank. He's done with his RMD for the year. Now, being charitable people, they donate $5,000 to charity. The end result is that the charity gets $5,000. Everybody understands that, right? Well, let's look more closely. By virtue of giving to charity this way, Albert and Shirley's $5,000 charitable contribution will cost them a total of $6,200. Why? Because the $5,000 required minimum distribution, RMD, that went into Albert's checking account at the beginning of the year still has a tax cost. Remember, the couple is in the 24% tax bracket, and 24% times 5,000 equals $1,200. So the $1,200 of additional tax that Albert and Shirley must pay when they file their taxes means the total cost of their charitable gift is $5,000 plus $1,200 or $6,200. Remember, the gift didn't impact their standard deduction or the RMD behind the gift, just added to their income. Ouch. Okay. Let's go to option 2. Okay, so option 2. Let's see what happens if Albert and Shirley use the QCD or Qualified Trouble Distribution way to give the $5,000 to charity. Instead of requesting a $5,000 distribution from his IRA to go into his bank account, Albert would simply have his IRA custodian transfer the $5,000 RMD directly from his IRA to the charity. That satisfies Albert's yearly requirement of distribution. Now the charity is in the same position as before. They receive a $5,000 donation, a good day. Albert and Shirley, however, are in a better position. They still give $5,000 to charity. Even though they receive no deduction for making a contribution, their IRA distribution is excluded from their tax return. Therefore, they owe no income tax on the $5,000 distribution. Their total cost to give the $5,000 to charity is $5,000, a $1,200 savings over their previous example, simply by knowing how to use the tax rules to their advantage. And they did it without ever getting a deduction. Well, we all know charity starts at home, so it's a natural question to ask, how does retirement tax planning figure in? It's a very good question because the government still wants its share of those tax-deferred assets when you pass away. And like we've seen, how you set things up really matters. Which leads us to our final key, number 4. Organize your assets for your family's benefit. Estate planning still matters. Okay, enough about estate planning. Let's talk about long-term care. This is not a long-term care presentation, it's about retirement and taxes, but believe it or not, there are a number of tax breaks associated with long-term care insurance. For example, long-term care premiums may be a deductible medical expense at the federal level and possibly eligible for deductions or credits at the state tax level. And on the other side, if you are receiving long-term care benefits, in many cases, those benefits are tax-free. For instance, benefits received from reimbursement-style policies are tax-free. In addition, cash benefit policies are tax-free if they don't exceed the higher of your actual long-term care costs or an IRS daily limit, currently $380. Choosing how you pay for your long-term costs can have a big impact on your estate and your heirs. In recent years, non-traditional long-term care policies that blend together some long-term care insurance and life insurance have become popular. Often the first inclination of the insured here is to tap the policy for long-term care costs, but that's often a tax mistake. Let's look at Florence, a widowed woman who qualifies for long-term care benefits and lives at home with in-home care. Her yearly care costs are $60,000. Florence's Social Security benefit is $20,000 annually, which covers her basic expense, but not long-term care. She also has $400,000 in an IRA and a life insurance policy with a long-term care rider that will pay $500,000 to Florence's children upon her death. Alternatively, Florence could use up to $10,000 per month for long-term care costs. Any amounts used for long-term care will reduce the life insurance death benefit. Please note this is just an example, it's not meant to represent any specific policy, but many long-term hybrid life insurance policies work this way. First, suppose Florence is infirmed for 5 years and uses her policy to pay for long-term care expenses. That's why she bought it, right? Here, Florence pays little to no income tax during this period because she'll have such a large unreimbursed medical expense deductions. The $500,000 policy pays out $300,000, $60,000 per year for 5 years. That means her kids will inherit tax-free life insurance of $200,000, the remainder of the $500,000 policy value. In addition, her children will receive the $400,000 in her IRA, which will be taxable to them. Now, let's suppose Florence lives for the same 5 years, but uses her IRA money to pay for long-term care expenses instead. Florence still pays minimal income tax per year because of her high medical expense deduction. And now the kids will inherit the $500,000 of life insurance completely tax-free, as well as roughly $100,000 of remaining IRA money, which will be taxable. Comparing the scenarios, the ultimate net benefit is unknown because it depends on Florence's children's tax rates, but it's hard to imagine a scenario where paying for care with $300,000 of taxable money with minimal cost of Florence is not a better option than paying for care with $300,000 of tax-free money. In the second scenario, we're preserving the tax-free money for her heirs and paying for the long-term care with Florence's taxable IRA money. Okay, we're nearing the end, and you're probably thinking, goodness, how in the world will we ever manage this? It's a good question, so let's bring it all together. We started with a clear statement about the problem. Retirees often pay more taxes than expected because a confusing system treats various income types differently and contains hidden taxes and penalties. So let's do a quick review on what we've learned in the context of the 4 stages of retirement. Under the pre-retirement heading, we saw the importance of understanding the after-tax value of your retirement savings before you retire. And we also saw that in those pre-retirement years, it's critical to consider your tax-deferred savings and start taking advantage of funding Roth accounts to fill your brackets, something you'll do throughout your early retirement years and low tax years. We also looked at Social Security and taxes, plus the importance of couples having benefit strategies that consider the surviving spouse. And we saw Medicare has its own tax-like structure that can push you off the perma cliff. And we saw the importance of signing up for Medicare on time, right in the middle of those early high earning years. That's because starting in your middle retirement years, you'll be confronted with required distributions, and we've seen the importance of planning your income needs before then and tax issues involved. And then we saw the importance of setting up your assets and managing them during the later years of retirement so that you can preserve the most for your heirs and leave them with the most tax flexibility. All those items together lead us to this obvious solution to the original problem. Because your tax exposure will change throughout retirement, you need a strategy that anticipates how and when you tap your assets to cover your personal expenses, understands the range of taxes you will face at various stages, and manages your actions so you pay as low a tax rate as possible. By attending this presentation, you're indicating you're preparing to leave the accumulation phase, saving for retirement, and moving to the distribution phase when you start spending retirement assets. We've seen that the distribution phase is more complicated than working and collecting a paycheck, and managing your tax rate through the 4 stages of retirement is part of the challenge of retirement planning. We've seen the cost of mistakes. Naturally, we want to be efficient with our savings, and there are strategies to reduce your tax burden. But as with many things in life, this takes education and planning and advice. It's a lot to think about. Our tax code is complex, and the rules keep changing. What doesn't change is your need to plan. I hope you learned a lot about taxes in retirement today. I realize it's a big time commitment on your end to make it here today. You took your time out of your day from your commitments to work and family, and because of your commitment, my goal is that this hour you spent with me will be the most valuable hour you'll spend with a professional all year. Another goal of mine is to prevent you from making mistakes. I often see people make mistakes with taxes and retirement strategies that can have negative implications. Wherever I see an opportunity on a case-by-case basis to prevent you from making mistakes, it's my goal to make those mistakes visible to you and to help you avoid them. I'd like to help you get started with creating a retirement tax planning strategy. I want to help you be prepared and organized for this aspect of your life so that you and your family can have peace of mind, knowing you've got a plan for making the most of your retirement accounts. What this means, folks, and why this matters is that when you have a completed analysis, we'll be able to rest easy with the knowledge that we've mathematically tested your strategy. You can officially stop worrying if you'll outlive your money. So I'll take a look at the question and answer box to answer a couple of your questions in the time we have left, but I'll be following up with a phone call to answer your individual questions one-on-one. Okay, so let's take a look at the Q&A box. Okay. We only have time for basically one question. I've got a question about what's a good time to start taking Social Security? So again, that depends on your income and your tax bracket, as well as obviously how long you want to work. Generally, if you plan to keep working past the age of 65, we want you to delay taking Social Security if you can, because your Social Security benefit keeps going up every year. And it will, at 70 years old, your Social Security benefits will stop increasing. So if you can delay, that's great. Just means you get a higher income once you start your Social Security benefits. So again, I appreciate your questions, your participation in this webinar, and look forward to talking to each one of you one-on-one. Thanks so much for attending. Appreciate it.